The question name is Kabelo. It came in December 2023. Part A, adjust the pre-populated spreadsheet to prepare revised extracts for the operating and investing activities of the consolidated statement of cash flows for the Kabelo group for the year ended December X5, 14 marks. So basically, we have to revise this spreadsheet and only two activities. One is operating and another is investing. How many marks? 14. Okay. A2. Explain the adjustment required to correct operating and investing activities of the consolidated statement of cash flow. Of course, while preparing a revised pre-populated spreadsheet, we will be doing number of adjustments. All those adjustments you are supposed to explain as well. Just an example, assuming we know that non-cash item, for example, like let's talk about depreciation, which is a non-cash item. We deduct depreciation while preparing income statement, and that depreciation actually reduces your profit. But itself, depreciation is not a cash outflow, it's just a non-cash item. So under operating activities, what do? We add back that cash items. So whatever adjustment we'll be doing in A1, then you need to explain in A2. Explain the adjustment required to correct the operating and investing activities of the consolidated statement of cash flow for the Kabelo group for the year ended December X5, 10 marks. Obviously, whoever can attempt A1, then you can simply explain all those adjustments as well. B. Using exhibit to advise the financial controller as to how the various financial instrument including the OD should be presented in the consolidated statement of cash flows. We'll see that, but when it comes to OD, we know that overdraft is repayable on demand. So obviously, if I have the facility of OD and I know that it is repayable on demand, but my company, my group will take this OD as cash and cash equivalent. So logically, OD will be a part of cash and cash equivalent. But there's one more concept. What is that? Assuming my company is having a OD limit of assuming $2 million. XYZ Bank, they have given us the facility of OD limit of $2 million. Means whenever we want, we can utilize this OD limit of 2 million. Okay. If all the time this 2 million OD limit is being used, all the time. Okay. If this 2 million is used by the group, used by the company all the time, then we'll say, since you are using this OD all the time, it is not you are using as and when on required basis. If the group says, question says, examiner says, we are using this 2 million time, $2 million OD limit all the time, then we'll say that you are actually treating this OD as a long-term source of finance. If you're treating OD as a long-term source of finance, then it becomes the part of financing activities. So there are two explanations. One is very normal explanation, which we know that normally OD is a part of cash and cash equivalent. But another understanding is, if whatever the limit bank has given me, all the time I've utilized that limit, I'm not repaying them, I don't have the cash right now, for example, and all the time the entire limit is being used by the company, then we'll say, if you are simply using OD as a long-term source of finance, then it will fall in financing activities. Let's go for part A1. Okay. Kabelo Group is the parent company of a group whose financial year end is December 31st, December X5. The following exhibit provide information relevant to the question. Acquisition of Trodosco company provides information. Acquisition of Trodosco provides information regarding acquisition of Trudeau's company and other information relevant to complete the consolidated statement of cash flow. Then we have got financial instrument, contains information about number of financial instruments held by the Kabelo group. Consolidated statements. This includes ODA draft extract from the consolidated statement of cash flow together with extract from the finalized consolidated statement of financial position. Year ended X5 including comparative figures. Okay. The information should be used to answer the question required. Acquisition of orders. Now stop. Whenever, number one, we are solving a cash flow statement question. Number two, during there, we have acquired a subsidiary. First of all, if you have acquired a subsidiary, acquisition of subsidiary is an investing activity. It's not an operating activity. I'm acquiring a subsidiary. That's my investment. Okay. Another point. For example, just an example, okay. A PLC, which is parent, they acquired B PLC, okay. Assuming A PLC, I'm just assuming A PLC acquired 90% during there of B PLC. Of course, parent and subsidiary. Parent and subsidiary, fine. Assuming in order to acquire B PLC, A PLC paid cash paid is 100 million. We know that acquisition of a subsidiary is an investing activity, okay? And let's say APLC, I'm assuming they paid 100 million to acquire BPLC. At the time of acquisition, BPLC was having cash of, let's say they were having 30 million cash. So in group cash flow statement under investing activities, acquisition of subsidiary, acquisition of BPLC. Actually, we are paying 100 million. There's no doubt about it. But we are getting 30 as well, which means that if there is outflow of 100, then there is an inflow of 30 as well. Logically, there should be outflow of only 70 million. Even though the parent has paid 100 million, but the point is, you paid 100 million outflow, but at that time your subsidiary was having 30 million cash as well, which is inflow for you. So logically, under investing activities, acquisition of subsidiary, we will show outflow of 70 million. Another point, for example, I want to calculate cash purchase of property, plant and equipment. And during that, I have acquired a subsidiary. I'll take BD from the group SOFP. I will take CD from the group SOFP. We know that due to depreciation for the year, your property, plant and equipment carrying amount will reduce. If there is any impairment loss during the in your property, plant and equipment, that will reduce the carrying amount of property, plant and equipment. If there is any disposal, that will reduce property, plant and equipment carrying amount. But important point, if I've acquired a subsidiary during there, so of course when the subsidiary comes, normally they will come with, they will also have, normally they will be having property, plant and equipment as well, which means that I'm just writing acquisition of BPLC, but from acquisition of BPLC, I will just write the property, plant and equipment of my subsidiary. Okay. Now let's, whatever the total comes here. If during there is any revaluation surplus, if there is any revaluation surplus, I'll take that here also. if at acquisition there is any fair value adjustment regarding property, plant and equipment. So I will take that fair value adjustment also. Then here I'll get a balancing figure. This balancing figure will be actually your cash purchases. What I want to say, try to understand, when I'm acquiring a subsidiary, during there. So number one, it's your investing activity. Second, either there will be cash inflow or outflow only in investing activities. Other than that, if you are calculating cash purchase of property, plant and equipment, make sure do not ignore that during there. If you have acquired a subsidy, then due to that also your property, plant and equipment now. Another point, whenever we acquire a subsidiary during there, normally what happens? Normally, I'm just giving you a standard past paper practice. Normally, we will be calculating goodwill because during there I've acquired a subsidiary. So whatever the goodwill comes at acquisition, normally if I make T account of goodwill, I'll get BD from consolidated SOFP. I will get CD from consolidated SOFP. Then again acquisition of subsidiary. But from acquisition of subsidiary, I'll be adding here what? Goodwill at acquisition. Goodwill at acquisition. Then normally balancing figure if I'm having here, that will be my impairment loss. And we know that whatever profit value examiner has given, we will add back this impairment loss. Why do I need to add back this impairment loss? Can I say due to goodwill impairment? Group profit has reduced, but logically, goodwill impairment itself, it's not cash outflow. It's a non-cash item. That is why we add back this into the group profit. Actually, in cash flow statement, we are just concerned with cash inflows and outflows. So generally, whenever we are acquiring a subsidiary, you will see that we will be calculating goodwill and then prepare the T account of goodwill to calculate impairment loss of goodwill. Why do I need to add back this into the profit? Because due to goodwill impairment loss, group profit has reduced, but actually it is not cash outflow. It's a non-cash item. That is why we add back this to the profit. Okay. Another important point. Consolidated SOFP. 2025 and 24. Okay. Inventories. Assuming inventory is $3 million, $300 million. 25. Previously it was 180. Receivable, let's say 120. Previously, I'm assuming it was, let's say 140. I'm just assuming it, okay? Trade payables, assuming 100 and previously it was 60. Again, just an assumption, fine. This is all coming from consolidated SOFP. During 2025, APLC acquired BPLC. And we know that acquisition of subsidiaries and investing activity. Fine. Now, obviously, during 2025, APLC has acquired BPLC. It means in Group SOFP as at 31st December 2025 will have the impact of inventories of BPLC, receivable of BPLC, and payable of BPLC. So the impact of acquisition of subsidiaries, inventory, receivable, and payable is included in 2025 balances. It is not included in 2024 balances. Why? Because in 2024 I did not acquire this subsidiary. I've acquired the subsidiary during 2025. So logically, the impact of acquisition of BPLC is included in 2025 balances. Okay. So I'll say 2025 balances, they are closing balances for me. And they are 2024 opening balances. Logically, when we are acquiring a subsidiary, then impact is included in the closing balances. If I'm selling the subsidiary during there, then impact is included in the opening balances. Okay, now listen. While calculating working capital changes for group cash flow statement, while calculating working capital changes for group cash flow statement, if you have acquired a subsidiary during there, first you have to exclude all the impact of acquisition of the subsidiary from the closing balances, and then you will take the difference. Now I'm assuming that BPLC is having inventories, let's say they are having inventories 20 million, assuming they are having receivable 30, assuming they are having payables, let's take it 10. I'm just assuming, okay? 20, 30, and 10. Now, what are you going to do? So now I will not directly take the difference between 300 and 180. Logically, what I'm going to do, inventories, closing inventory is 300. Logically, acquisition of subsidiary during there, I'll exclude the impact of this, which is 20. I'll get 280. Previously, it was how much? 180. Now I will take the difference. From 180 to 280, there is increase in inventory by 100. Increase in inventories, I'll show this as an outflow. Why do we show this as an outflow? There are two understandings. You can take any one of them. One, more inventory means we have put more money to the inventory. We have invested more in the stock. That is why outflow. Another reason, actually, if your closing inventory increases, then logically what happens? Your profit will also increase. When your closing inventory increases, I'm assuming that your inventory increases by 100. Try to understand. If the inventory increases by 100, then your profit will also increase by 100. Closing inventory, logically, the more the closing inventory is, it will increase your profit. But try to understand, your inventory has increased, your profit has increased, but logically, it is not your cash inflow. Try to understand. I'm actually putting more money to the inventories. So it is logically should be outflow rather than taking it as an inflow. So basically, increase in inventory means we have invested more money into stock. That is why we show that as an outflow. Okay, another point, receivable. Now directly I will not take the difference of 140 and 120. What I'm going to do, since I've acquired a subsidiary during there, so I will first exclude the impact from the closing balance, which is let's say 30. I'll come to 90. Now from 140, I'll come to 90. I can see there's a decrease of 50. If your receivable decreases, then I'll show this as an inflow. Decrease means we have collected the money. So the concept is, if you have acquired a subsidiary during there, first exclude the effect of working capital from the closing balances of group SOFP and then take the difference of inventory receivable and payables. If there is increase in inventory, in a very first class we have also discussed increase in inventories, just recall we show that as an outflow in the group statement. Increase in receivable, outflow. If there is increase in trade payable, then I'll show this as an inflow. Of course, decrease will be exactly opposite. Another concept, if during there I have assuming sold a subsidiary, of course, even if you are selling a subsidiary during there, again your investing activity, either there will be cash inflow or outflow for while you are selling a subsidiary. But the important point is, if during there you have sold a subsidiary, so number one concept is the subsidiary which I have sold during there, obviously impact of that subsidy will not have, now there will be no assets, no liabilities in the closing balances of group SOFP regarding that subsidy which I have sold. Now what do you need to do while preparing a group cash flow statement, how to deal with the subsidy which I have sold? The subsidy which you have sold during there, first exclude their impact from the opening balances of inventory receivable and payable and then take the difference between opening and closing balances. So if I'm acquiring a subsidy during there, first I'll be excluding the impact from the closing balances. If I'm selling the subsidy during there, then I will exclude the impact from the opening balances. Now another important concept which you need to understand. Try to understand, student, now, otherwise mathematically sometimes that disturbs the students. Closing balance in my example is 300. Acquisition of subsidy, let's say that subsidy was having inventory of 20. So first we excluded 20 from the closing balance. Now the closing balance is 280. Previously opening balance was 180. So there's an increase of 100. Now if your examiner says that 180, 300 directly, the difference is 120. Now try to understand. We know that increase in inventory we have to show as an outflow. Examiner says I have directly taken the difference between opening and closing balances. I did not account for acquisition of subsidiary. I do not, while dealing with the working capital, I did not consider that we have acquired a subsidiary during there, even though we did. Even though we have acquired a subsidiary, but when I was preparing group cash flow statement, I did not consider that point. So examiner says I have directly taken increase in the inventory 120, and according to our understanding this increase should have been 100 rather than 120. Now in pre-populated SOFP, how to do the adjustment? This is 120 in draft cash flow statement which examiner has given us, but I know that this 120 should become 100. So what I'm going to do, I'll be opening one new column. The name is working capital. Let's say working capital adjustment. Now try to understand, students. Logically, we know that increase in 120 should have been the increase of 100 rather than 120. Look at this, what I'm doing. I'm just adding 20 here. Now you have to be little bit good in maths, please. 120 negative examiner has given me, which is increase in inventory, but I know that increase should have been 100 rather than 120. So what I'm doing, working average adjustment, I'm writing positive 20. When I'm going to net off both of these, I'll get negative 100. So examiner has given me the increase in inventory 120 and examiner told me that I did not consider the impact of acquisition of substrate. So how to deal with in pre-populated cash flow statement? I'm going to open one column. The name of that column will be working capital adjustments. Then I know that instead of 120, it should have been 100. So mathematically, what I'm writing positive 20 here. Now, one more example. Let's see this. 120 minus 140. So that is negative 20. Examiner says that I have taken, there's a decrease. Decrease in receivable is 20. We know that decrease in receivable you have to show positive. Okay. Try to understand now. Student, please watch it. What examiner says, I've just taken the difference between 140 and 120. Again, examiner says, I did not consider that during there we have acquired a substrate. Now we know that the closing balance of receivable is 120. During there we have acquired a substrate which is having a receivable 30. So logically the closing balance is 90. Opening is 140. So the difference between 140 and 90 is 50. Obviously 50 is still decrease, but it is 50. It is not 20. So what I'm going to do, examiner has already given me 20 here. Keep watching. I'll bring 30 more. So the decrease becomes 50. So the decrease becomes 50. Another way, let me give you one more example. Assuming 2025 receivable balance is, assuming the receivable balance is 300, okay? 24, the balance is 200. Keep watching, students, very important now. It's group SOFP. Previously, the balance was 200 million. In the current year, which is 25, the balance is 300, okay? So in group cash flow statement, you can see there's an increase of 100. Increase in trade receivable is 100 million. We know that increase in inventories receivable in group cash flow statement, we show them as an outflow. Okay, now examiner gives you further information, and during further information, examiner says during there we have acquired a subsidy, but while dealing with working capital, in case under cash flow statement, I did not consider the acquisition of subsidiary. Fine. Assuming acquisition of subsidiary, which impact examiner did not consider, your examiner says subsidiary is having the receivable balance of 120 million. Subsidiary is having the receivable balance of 120 million. Now, should try to understand, okay? Examiner says, I did not consider that. Okay. So logically, how to deal with that? From 300 first, we will exclude the balance of the subsidy which we acquired during there. So from 300 minus 120, I'll get 180. Now I will take the difference between 200 and 180. If you see the difference between 200 and 180, I can clearly see there is a decrease of 20 million rather than increase. Student, check this. Now I don't have the increase in receivable. Logically, I've got decrease in receivable. And the amount of decrease is 20. And if your receivable decreases, we show that in cash flow statement as positive. So logically, relating to this receivable, your answer should be decrease in receivable and the positive amount 20. Now examiner has given us negative 100. What I'm going to do now, this is very important. Logically, revise cash flow statement. Instead of increase, should have the decrease, and decrease of receivable should be 20, and we know that 20 has to be in positive. Okay. So student, if I need to have a 20, I need to bring 20 positive in my revised statement. So what I'm doing there is very important. Look at this. In my working capital adjustment, I'm writing 120 positive. Instead of increase, it will become now decrease. Now try to understand. Examiner has given us negative 100. In working capital column, if I write 120 positive, then it will give me 20 net positive amount which I actually need. Is that clear, students, now? So you can also deal like this, that what should be the revised balance. So revised balance, this time actually we need 20. So how to bring 20? Then I'll be adding here. There should be working capital adjustment should be 120 positive. So you have to be little bit, I would say, good when it comes to little bit in maths also. That examiner has given me negative 100, but I need to have a positive 20 balance. So there's only one way that I'll be having a 120 positive here. So students, all you need is, the concept is, if I'm acquiring a subsidy during their first, exclude their impact from the closing balances and then deal with the working capital. Okay. Let's come here now. It all came because we saw there is acquisition of a substrate. Acquisition of traders. Kabelo acquired 80% of 100,000 equity shares of Traders company on 30th June X5. The consideration consists of a cash payment, $5 per share acquired. Now stop. Kabelo acquired 1 lakh shares, 80% of that. So we got 80% of 100,000 shares. We paid $5 per share. So it means cash paid. Cash paid by the parent is 4 lakh. Okay. Of course, while acquiring a subsidy, if you are paying cash, that is your outflow. But you have to also consider, do you have any cash balance in your subsidy? That will be net off from this amount. The consideration consists of cash payment $5 per share acquired and issue of one Kabelo company $1 equity share for every 4 shares acquired in Traders company. Now listen, student. Parent has not given the consideration only in the form of cash. Parent has also issued the shares. Now, very important point. Parent has acquired a subsidy, partly paying cash and partly paying consideration in the form of issuing of shares. Now, here the parent, what parent is doing? Parent is actually getting the control of a subsidiary by issuing the shares. Now, listen, students. When you issue the shares and acquired a subsidiary, we consider that as a non-cash transaction. Logically here, due to issue of shares, parent is not raising any cash. If normally a company issues shares and raises cash, it is considered in your financing activities. But right now, it is not a cash transaction. We are just, parent is acquiring a subsidy by issuing shares. Okay. And we need to know parent's share price. Kabelo company policies to value non-controlling interest at fair value fine at the date of acquisition. The fair value of Kabelo's and Trudeau's shares on 30th June X5, 13 and 8. It means that 100,000, we acquired 80%. Parent issued 1 share against 4. And share price of parent is 13. Let me use the calculator. So basically, market value of shares issued by the parent is 2 lakh 60. And generally, I'm saying, whenever subsidy share price is given at acquisition and the policy is to keep NCI at fair value, normally subsidy share price we use for finding out the fair value of NCI at acquisition. So 100,000, parents holding is 80, so NCI holding is 20 into 8. So fair value of NC at acquisition is 160. If I add all of them, so I'll have the value of the investment. Okay, let's go ahead. The carrying amount of net asset reported by traders 30th June is my acquisition date. Student, don't forget this. Carrying amount of net asset at acquisition basically examiner is giving us, and the net asset at acquisition is 7,47,600. Fine, that helps us. That helps us in calculating goodwill. The only fair value adjustment on acquisition related to plant, which had a fair value 50,000 above its carrying amount. So 7,47,000. We will add 50. Fair value adjustment. The group pays tax at 30% and deferred tax was correctly accounted for within the consolidated statement of financial position. Now stop. If there is fair value adjustment, normally that fair value adjustment results, if there is a fair value adjustment upward, we can see that we can see here that there's a rise in the value of plant. So due to this fair value adjustment, deferred tax liability will also arise at acquisition, and that deferred tax liability will also work as a fair value adjustment. Tax rate is 30%, which means that logically 7,47,600, they will increase by 50,000 due to fair value adjustment, but they will also increase by deferred tax liability, 30% of that, because liability of course will decrease your net assets. Okay. The taxation figure in the statement of profit and loss is 3,85,600. This figure has been included as taxation paid within the draft statement of cash flow. So they have taken out tax paid 3,85,600, but we have to check the correct amount. Okay, let's see. The group financial controller has accurately completed the consolidated statement of financial position and consolidated statement of P&L and other comprehensive income. Fine, but the consolidated statement of cash flow is in draft, so it is not finalized. The financial controller has not yet considered the impact of acquisition of Trodler's company on the consolidated statement of cash flow. So actually examiner forgot to consider the impact of acquisition of subsidiary. Fine. Just a minute. We can very easily calculate goodwill if I'm not wrong, because we have everything. Okay, we'll come to this. Let's read more. The statement of cash flow figures for movement in the inventories, receivable, payable, and property, plant, and equipment have been calculated by considering simply differences in the year-end balances in the consolidated statement of financial position from December 4 to 5. So again, they did not consider, of course, examiner has already told us, they did not consider acquisition of substrate. Goodwill of Total Company was impaired during there. There were no other goodwill impairment within the group, so there's an impairment loss as well. That impairment loss will be added back. The depreciation charge of the group for the year is X5. They have specifically given us the depreciation charge of the group for the year ended is December's X5 is 6,25,060. There were no disposal of non-current asset by the group during there, although there were some additions paid. There was during there they did buy property, plant, and equipment for cash, but no disposal at all. Now one more important point. We can see that the question says the only fair value adjustment on acquisition related to plant which had a fair value was 50,000. We can see that fair value adjustment relates to a depreciable asset. Of course, we know that on depreciable asset, there will be additional depreciation on fair value adjustment. But exactly what is the amount of additional depreciation on 50,000? Examiner has not given us the remaining life of the plant. That is why we are unable to calculate the depreciation amount which comes due to this 50,000. So that is why whatever examiner has given us the value of the depreciation for the entire group, we will simply assume the impact of additional depreciation on fair value adjustment is included in that depreciation. Because examiner has not given us any other information regarding what is the life of this plant in which the fair value adjustment is coming. So simply we don't have enough information to depreciate this 50,000 fair value adjustment. That is why whatever depreciation examiner has given us, it means it includes the impact of depreciation which actually comes on fair value adjustment. Now, if I just show you quickly working one. Okay, let's take it here, working one. Let's calculate goodwill. After the calculation of goodwill, you will be in a position to calculate impairment loss. Very easily, we will be able to calculate. Uh, I think cash paid was 4 lakh. Then share exchange. 100,000, 80% of that. I think it was 1 upon 4 and share price of the parent was 13. That gave us 260. Then fair value of NCI. Fair value of NCI. 1 lakh, 20%. Share price was 8. 160. Let me use the calculator. 4 lakh plus 260 plus 160 gives us total 8 lakh 20,000. Simply less net assets at acquisition. They have already given us the carrying amount of net assets. Carrying amount, examiner has given us the carrying amount. Where is the carrying amount? 7,47,600. Carrying amount is 7 lakh. 47,600. 7,47,600. Fair value adjustment. Plant 50. Due to this, there will be a deferred tax liability. 50,000, 30% of that. 15,000. So 7,47,600 plus 50,000 minus 15. Students, I'm getting 7,82,600. So goodwill at acquisition is 37,000. $37,400. Let's see what is a goodwill BD amount. Goodwill brought down. Extract from the statement of financial position is here. Goodwill brought down is 41,100. And goodwill CD is 4,47,400. Goodwill brought down. I will add goodwill BD 4,40,100. Let's see what I'm getting. Getting 4,78,500. If it is equal to the amount, then there is no impairment loss. But if it is more than the CD amount, then difference is your impairment loss. Goodwill CD, let's go back, is 4,47,400. Here comes impairment loss. That will be added to the operating profit. 31,100. Or another way of dealing with this, goodwill, BD and CD. BD is 4,41,100. Carried down is 4,47,000. Acquisition of Trudeau's company. It brings goodwill of 37,400. Four lakh 78,500. 4,78,500. Obviously, the balancing figure is impairment loss. 31,000. I strongly believe it is 100% clear to everyone. And logically, this impairment loss will be added to the operating profit. Actually, impairment loss has reduced your profit, but it's not cash outflow. And whatever adjustment we'll be doing in A1, all you need to explain, these adjustments you will be explaining in A2 as well. Okay, this is goodwill. Question. Students. Of course, impairment in your assets T account always comes on credit side. Impairment actually reduces your asset, and credit side actually reduces your asset, not the debit. Please, exams are very near. Okay. Let's try to calculate property, plant, and equipment purchases as well, cash purchases. Then we'll be dealing with this. Come here. Working to I'm just explaining all the adjustments to you, property, plant, and equipment. Brought down, carried down. Calculate. Group SOFP, they have given us 3 million, 3.1253 million. Let me write on the calculator. BD. 3,125,300. CD. What was the amount? 3,668,900. 366. There is a CD. Depreciation, I think they have given us, if I'm not wrong. There was one fair value adjustment as well. Let's see the group depreciation. Group depreciation is here. 6,25,060. 6 lakh 25,060. Okay. Due to acquisition of Trodor's subsidiary. Look at this. Carrying amount of net asset of Trodor's. We acquired a subsidy and the property, plant and equipment which came with the subsidy is 4,21,000. 4 lakh 21,000. Acquisition of Trodosco 4 lakh 41,000. 4 lakh? What was that? 4 lakh 21. Logically, both the sides should be balanced. 6,25,060 plus 3,668,900. I'm getting 429,3960. Balancing figure will be your cash purchases. And we show cash purchases as an outflow in investing activities. Students, I'm getting 6,97,660 cash purchases. And cash purchases we show in our investing activities as an outflow. I hope it is clear to everyone. Please kindly reply. Okay. Draft extract from the consolidated statement of cash flow for the Kabelo group for the year ended. Cash flow from operating activities. Examiner has given us the operating profit added to the depreciation. Perfect. I cannot see any impairment. There should be impairment also, which we need to add. Yes or no? Then we'll come to receivable, payable, and other receivable, inventory, receivable, and payable. Then we have got taxation paid also. Let's check. Acquisition of property, plant, and equipment. They are saying this, but this is not the correct balance. I think we have calculated the correct one. Concession paid for acquisition of Todors. They have not calculated yet. We know that cash paid was 4 lakh. And how much cash subsidy was having? Subsidiaries cash is 24,900. Logically, can I say in your investing activities, your outflow will be 400,000, which parent has paid minus 24 minus 24,900. Student, I'm getting 3,75,100. So this will be your outflow. Actually, 400, entire 400,000 will not be outflow because if we are paying 4 lakh, we are also getting 24,900. So the outflow is 3,75,100. Now let's quickly check taxation paid. Taxation, I can make the T account here. Working, I believe 3. BD, current tax, deferred tax, CD current tax, deferred tax. Then in profit and loss statement, if you have tax, obviously you will have. If there is any deferred tax in OCI, you will have to take that as well. Okay. If during there you have acquired a subsidiary, acquisition of subsidiary, and your examiner gives you the taxation details, then you have to take that as well because that will also increase your taxation. Now let's come here. First of all, examiner has not given us any taxation information here. No issue at all. But we know that at acquisition, due to fair value adjustment, we have seen the tax. If you recall, there was a fair value adjustment, if I'm not wrong, 50,000 into 30%. So 15,000 deferred tax liability. Deferred tax liability which is due to fair value adjustment. Of course, it increases your taxation. Now let's see the current tax and deferred tax, BD and CD. Group is here. Students, deferred tax liability is 2,50,000. Current tax is 2,56,900. 2,56,900 and 2,50,000. CD. Deferred tax is 130. Current tax is 3,64,300. 3,64,300. It was 130. What about P&L, profit and loss? Taxation, tax is here. The taxation figure in the statement of profit and loss is 3,85,600. 3 lakh 85,600. There's nothing in OCI. Let's see. 2,56,900 plus 2,50,000 plus 3,85,600 plus 15,000. I'm getting 907,500. So balancing figure will be tax paid. Tax paid. Let's see the balancing figure. From 907,500, I'll deduct 3,64,300 minus 1,30,000. Students, I'm getting 4,13,200. So basically, in revised statement, in revised cash flow statement, the tax which the deferred tax which they have calculated, this is not correct. In revised, we will show 4,13,200. Okay, now let's deal with this inventories, trade payable, trade and other receivables and payables. Now try to deal with that. Student, if you recall the concept at the start of the class, I have given you the concept. If during there I have acquired a subsidiary, then of course impact of inventory receivable and payable will be in the closing balances. First we will exclude the impact from the closing balances, then we will take the difference. Let's see. Examiner has categorically mentioned that while calculating working capital, inventory, receivable and payable impact, examiner did not consider the acquisition of subsidiary. Okay. Now, you need to understand few things. What examiner says? Increase in inventories. My question is, please reply to me then. If your examiner says there's a rise in the receivable is 6,58,100 rise. So can I say it means closing inventory is more than 6,58,100 more than the opening inventory? Yes or no? Please reply. I'm not interested what is the total closing inventory balance. I just want to say one thing. If my examiner says the increase in inventory is 6,58,100, so I'll say, okay, whatever the total closing inventory is, I'm not interested in that. But I know one thing, that closing balance is 6,58,100 is more than the opening inventory. And when it comes to receivable, which is 2 lakh 11,500, I'll say the closing receivable is more than opening, and the amount is 2 lakh 11,500. Payable is also more. So it means closing payable is more than the opening payable. Now I want to ask you guys, give me the answer. Can I say during there I've acquired a subsidiary? During there I've acquired a subsidiary. So can I say I have to exclude the impact of acquisition of my subsidiary? Can I say when I'm going to exclude the impact of acquisition of subsidiary from the closing balances, so whatever examiner has written here, logically it will reduce. Whatever examiner has written here, logically it will reduce. Whatever examiner has written here, logically it will reduce. Tell me yes or no, please. Right now, what has happened, examiner has taken the difference. Examiner has just taken the difference between opening and closing balances, and by looking at this information, we have already decided closing inventory is more than the opening. Again, the closing receivable, they are more than the opening, and the closing payable, they are the more than opening. And during there, we have acquired a subsidiary, and we have to exclude their impact from the closing balances. When I'm going to exclude the impact from the closing balances, so whatever values examiner has given me, these values logically will reduce. Keep that in your mind without minding it. Now let's see Trodors. The student inventory amount is 2 lakh 56,800. I want to say one thing. Logically, when I'm going to exclude the impact of inventory of 2,56,800 from the closing balance, so whatever increase examiner has written, it will actually reduce. So what I'm writing there is very interested. Let me first write the amount. 2,56,800. Closing balance of inventory will reduce by 2,56,800. Now try to understand what I want to write. Where is that amount? It's here. Just a minute. Leave this. Oh. Working capital adjustment. Examiner has given me 6,58,100. I'm just writing 2,56,800. Logically, this 2,56,800 will reduce your closing balance of the inventory. Then what will be your revised balance? Revised balance will be 658,100. Logically, the revised balance will be 4,13,000. Your revised balance will be 4,13,000. Now come here. Receivable is 2,23,000. Logically, the receivable will decrease. This when I'm going to exclude the impact of again acquisition of total from the receivable, so your receivable will decrease by 2,23,000. Now listen carefully. If you net off this, logically what I'm getting, that is again very interesting. Students, I'm getting positive 8,800, and in my final answer, instead of increase, by looking at the revised column, I will be writing decrease. Of course, I have to make the correction. Logically, in my revised cash flow statement, your receivable balance is not increased, it has actually reduced, and decrease in receivable we show as positive, which is 8,800. Now come to the payable amount. It is negative. Payable is negative 1,75,000. One lakh 75. So what do you get? 93,900 minus 175, 400. So students, I'm getting actually, here you have written increase in receivables. Rather than increase, I will get decrease, 81,500. So what I'm doing, all the values which examiner has given me, I'm just taking them as it is. Inventory, receivable and payables. It is negative, it will remain positive, net impact. Simple maths, nothing else. Negative, which is already written, then positive amount which I have taken, then final answer. If final answer is positive, then you should know that instead of increase, you should be writing decrease. If here it is negative, then instead of increase, you should be writing decrease. This is how you need to deal with this working capital adjustment. Taxation paid, correct amount of taxation paid, student, we have calculated, if I'm not wrong. It was 4 lakh something, which I've just deleted, I believe. Acquisition of a subsidy, we have also calculated. Now, how to basically adjust your pre-populated SOFP? Let me explain that. Taxation paid, students, cash flow from operating activities before income tax. So after that, you have to show taxation paid. Yeah, the presentation is according to IFRS 18. Let me just show you the pre-populated SOFP which I have. Oh, pre-populated cash flow statement which I have just corrected to save the time. Let me just share. I hope you can see both the, I would say, both of workings. You can see the PDF as well as Excel sheet if I'm not wrong. Student, look at this draft. Can you see this Excel? Yes or no? Please reply. Okay. Student, look at this consolidated statement of cash flow for Kabelo Group for the year ended. Cash flow from operating activities draft. The draft on everything is given to us in the question. Then working capital. This is the working capital adjustment which I've just discussed with you. Inventories, receivable, and then payable. These are the revised balances. Impairment I have added of I've shown that addition to the revised one. I've given the reference of working two. Your working could be working one, could be any other working, no issue at all. Taxation paid is here, students. 4,13,200. I hope we calculated this. We have calculated the same amount. Here comes the cash inflow. Then property and equipment. I believe we calculated the same value. This was the consideration paid. If you recall, we have given 4 lakh. At acquisition, subsidy was having 24,900. Difference is 3,75,100. And this is your cash outflow. I hope this pre-populated is clear to everyone. Quickly reply yes or no, please. I'm waiting. Now, so in this, I just want to give you a little homework. What is the little homework? For example, I think I first dealt with my working one was acquisition of, I think it was my working one. Now, what is your homework? A very small homework which I'm giving you. For example, working one, even though we did goodwill, there's no harm, you can do property, plant and equipment. First, let's say you are dealing with PPE. I want you to properly calculate the cash purchases of property, plant and equipment. This will be your working one, let's say. So that then working two will be, for example, goodwill impairment. And working three, there are only three workings. Working three is taxation paid. So student, I'm just giving you one small homework that on this Excel sheet, try to calculate value of property, plant and equipment, impairment loss of goodwill, and what else? Cash purchase of property, plant and equipment, impairment loss of goodwill, and taxation paid. So, student, will you be able to do it? Student, all you need is just replicate what we have done on the PDF. Quickly reply yes or no, please. This should not be disturbing you. Okay, now quickly I want to explain the adjustments what we have done. First of all, you have to explain. I'm just giving you the explanation of part A2. Please listen nicely. Because examiner has asked us that you need to explain the adjustment which you are doing in A1. First of all, before doing any adjustment, you have to just explain your examiner that in cash flow statement, we just focus on cash inflows and cash outflows. Then you will explain that while preparing cash flow statement, we have to exclude the impact of non-cash items. Okay. After that, just give the explanation that impairment loss in goodwill has actually reduced the operating profit, or simply has reduced the operating profit of the group, but itself impairment loss is not a cash outflow. That is why under operating activities, we add back the impairment loss. This much explanation for impairment loss of goodwill is good enough. And all you need is just write in your own wordings. I hope all my wordings are clear to everyone. It's very, very simple. But I'm not directly writing. Student, don't write directly like this. It's a non-cash item. Just add back, please. It means you are in very hurry. First, I said in cash flow statement, we are just concerned with cash inflows and outflows. And then I've explained my examiner that all non-cash items impact should be excluded. Then I'll explain that impairment loss has actually reduced the operating profit of the group, but itself impairment loss is not a cash outflow. That is why we add back this, or you can say that is why we added back this to the operating activities. We have added back this to increase the operating profit. Fine. Then next, let's talk about working capital adjustment, which we have done it. First, you need to explain your examiner. Acquisition of subsidy is an investing activity. It is not the operating activity. Acquisition of subsidy is an investing activity. It's not the operating activity. That is why, while calculating working capital changes in a cash flow statement, we have to exclude the impact of acquisition of subsidy from the closing balances. And then we have to take the difference between opening and adjusted closing balances. After that, we have to just explain your examiner that increase in inventories will reduce by 2,56,800 when we'll be adjusting, when we'll be excluding the impact of acquisition of traders. Receivable will reduce by 2,20,300 and payable will decrease by 1,75,400. So final balances. But how we are giving the explanation, number one point was acquisition of subsidy is an investing activity. It's not the operating activity. That is why while dealing with working capital, we have to exclude the impact of acquisition of subsidy from the closing balances. After that, we will be taking the difference between opening and closing balances. Then whatever you have done, you explain that. Okay. What else? Now also explain the taxation value. That while calculating taxation paid, we have to consider the tax which came because of fair value adjustment, if you recall. We have to consider that. So you have to mention that point also. What else? Then acquisition, then how did we calculate purchase of property, plant and equipment? You have to just explain your exam, that's it. That while calculating cash purchase of property, plant and equipment, group needs to make sure that your property, plant and equipment CD amount, carried down amount has actually increased due to the property, plant and equipment of traders at acquisition. It has also actually increased due to it will also increase due to, uh, it will also have the impact of fair value adjustment. So while basically calculating property, plant and equipment, just you need to explain 2 or 3 points. One, while calculating cash purchase of property, plant and equipment, you need to make sure that acquisition of subsidies, when we are acquiring a subsidy, the impact of property, plant and equipment will have to be considered in the T account ledger, whatever you say. Second, fair value adjustment impact. Otherwise, there's no, we have to consider these two while calculating cash purchase. So this is what you need to explain, no more explanation. But there was something else also. Let's go back to the requirement. Just a minute. I hope now we are on the PDF. In part B, they are asking using Exhibit 2 advise financial how to deal with various financial instruments. Exhibit 2, Exhibit 2, Exhibit 2. Where is Exhibit 2? Financial instrument contains information about a number of financial instruments held by Kabelo. Kabelo. It's here. Student, can you see the heading of financial instruments? Kindly reply. Students. Great. The Kabelo group has number of financial. Oh, something went wrong. The Kabelo group has number of financial instruments presented within the consolidated statement of financial position. Some group entities which had surplus cash reserves had acquired debentures in other non-group entities to increase returns. Other group entities had raised finance by issuing bonds. Now stop. How many marks do we have? Exhibit 2, Exhibit 2, Exhibit 2 marks. We have got 6 marks, okay? Now come back one by one. Cash surplus resources had acquired. Now listen. Acquisition of debentures. Acquisition of debenture means companies, they are simply making investment in debentures so that they can generate returns from their investment. Now listen, investment in debentures so that obviously they can generate a return from that investment, that falls in investing activities. When we are investing in debentures, from which we will be generating the returns, so investment in debenture actually falls in investing activities. And obviously buying them by giving cash, it is your cash outflow. So we'll show investment in debenture in our investing activities. Is that clear, student? Yes or no? Now let's talk about acquisition. Now after that, other group entities had raised finance by issuing debenture. Now listen, if the company issues if your company issues bonds to raise finance, it actually falls in financing activities. When company issues bond to raise finance, it actually falls in financing activity. It's like taking a bank loan. You are issuing the bond to raise the loan. Financing activities. Kabelo company financed the acquisition of Todos company by acquiring a bank loan. Bank loan is also bank loan. Taking a bank loan to buy a subsidy, taking a bank loan to buy a subsidy is also a financing. Taking bank loan is a financing activity. Acquisition of subsidies and investing activity. Students, are you getting the difference? Raising the finance by bank loan is a financing activities. But where I'm using that amount? I'm using that amount to acquire a subsidiary. Acquisition of subsidies and investing activity. But raising a bank loan is a financing activity. Is that clear? Quickly reply, please. There's a difference in this. Great. Kabelo also had an OD bank balance. The OD bank balance fluctuates regularly from in funds balance to an OD balance. Now listen, student. I think at the start of the class we mentioned. Normally you can say that normally bank OD facility, bank OD is treated in cash and cash equivalent. When I have the facility of OD, so it is treated as cash and cash equivalent. But after that you can say, but if whatever OD limit is given to the group, given to the company, it is always used the entire limit, then we will say that company is using OD as a long-term source of finance, then it will fall in financing activities. Otherwise, it is a part of cash and cash equivalent. So let me quickly give you let me repeat for you. Investing in debentures, simply investing activities. We'll be generating return from that. Issuing bond, financing activities. Taking bank loan to acquire a subsidy, acquisition of subsidy is an investing activity, but taking bank loan is a financing activity. OD is normally a part of cash and cash equivalent, but whatever OD limit is given to your company, that limit is always being used, fully used. If it looks that you are using OD as a long-term source of finance, then it will become a part of financing activities. I hope the entire explanation of last part is clear to everyone. All you need is just write in your own wordings. Is that clear, students? Okay. So, student, if you recall, now what is your homework? That is very important and kindly do it. One, you have to complete I would say, working part on spreadsheet. Second, you have to write the answer A2 in your own wordings and exhibit 2 answer also in your own wordings, which I have just explained you. Okay, that is a simple homework to you. Plus, if you recall, uh, I made a commitment with you that we will be conducting 7 live revision classes only on consolidation, and this is today's class was the 6th one. In first 2 classes, we have covered all the concepts of we have covered all the concepts of, I would say, consolidation, all concepts. Then in other 4 classes, in each class we have covered one proper recent past paper questions. Now we are left with only one more question, consolidation, that I will be doing from the ACCA pre-scene mock. But first you people will be attempting, then we will be doing it. If you need questions on cash flow statement, just send this query in your relevant WhatsApp group. I will reply there. So don't worry at all. Anything else? So regarding ACCA pre-scene mock, student, I would request, please, first you people need to attempt the ACCA pre-scene mock. Then we will be starting live debrief of ACCA pre-scene mock from coming Saturday. The entire plan admin is going to share with you. Don't worry at all. IFRS 19 is only important that much which I have taught you, which is included in my pre-recorded class. It's not that much. It's not so big. IFRS 19, you can see that. It's not a very big part of your syllabus. But you cannot leave it. So whatever I have covered in IFRS 19 in my lecture, only that much you have to cover it. That's it. There's no need to do anything extra. So students, that is all about today's class. Do give the feedback on today's class, and please, you need to do the homework. I want everyone to complete the homework today, immediately after the class. So hope to see you all in others in the coming classes as well, coming live revision classes as well. So that was a class number 6 on our, I would say, consolidation, you can say crash course. One class is left on consolidation, which we'll be discussing through ACCA pre-scene mock. One more thing, student. Proper debrief is available on June 25. Debrief is already uploaded on the portal. September debrief is already uploaded on the portal. Try to attend those mock, ACCA pre-scene mock, and then watch debrief. And then obviously finally you have to attempt a December 25 pre-scene mock, and then we'll be conducting a live debrief on that as well. So thank you very much. Thanks a lot, and please do give the feedback in your